afternoon, ladies and gentlemen. This episode is brought to you as part of the Investor Education and Awareness Initiative by the ICICI Prudential Asset Management Company. Today, we have an exciting topic to discuss: synergy between active and passive investing in building a portfolio. In the dynamic landscape of financial markets, investors are presented with a spectrum of choices between active and passive investment strategies. This webinar aims to explore the harmonious interplay between these two approaches, providing a comprehensive understanding of how they can collaboratively contribute to constructing a well-rounded investment portfolio. Active investing involves hands-on management, with fund managers making decisions based on market analysis and forecasts. On the other hand, passive investing adopts a more laid-back approach, tracking a market index and aiming to replicate its performance. The coexistence of these strategies offers investors a diversified toolkit, allowing them to leverage the strengths of both approaches for optimal portfolio construction. As we delve into the nuances of this synergy, our expert speakers will shed light on the advantages and challenges associated with each method. We will explore how active strategies bring flexibility and responsiveness to market changes, while passive strategies offer cost effectiveness and broad market exposure. Additionally, today's session will provide practical insights into how investors can strategically blend these methods to navigate diverse market conditions. To guide us through this session today, we have with us Mr. Chintan Haria from ICICI Pru MF and Mr. Mohit Garg, CEO and co-founder of Moneyfront. Let me give a short introduction of Mr. Chintan Haria. He has over 15 years of experience in the field of fund management and strategy portfolio management. He has been associated with ICICI Prudential Asset Management Company since 2005 as the principal investment strategy. Thanks for joining in, Mr. Chintan Haria. And we have with us Mr. Mohit Garg. He's an investment professional with over 15 years of experience in product, strategy, and managing UHNI portfolios across a myriad of investment tools like mutual funds, stocks, bonds, alternate assets, etc. Since 2016, he's the co-founder and CEO of Moneyfront, a robo-advisory platform. Welcome, Mr. Mohit Garg.
Thank you.
Now, moving on to our speakers, when it comes to active investing, Chintan, we want to understand, how does active investing contribute to portfolio resilience, especially in volatile market conditions? And what strategies do you recommend for managing risk?
So, as you mentioned, that active fund management becomes more important during volatile times. If you look at the last 20-year history in terms of Indian markets, there have been times where certain sectors have become extremely overvalued. Like in 1999, tech was overvalued, 2008, real estate was overvalued, and capital goods was overvalued. And in 2008, for example, the IT, FMCG, and pharma was highly undervalued relative to market. So active fund management involves buying those sets of segments of market which are cheap or which valuations are reasonable, and there is growth also in them over the next 3 to 5 years, while avoiding those stocks which are expensive and those which may show growth in the future, but that growth is more than built up in the current market price. So it's all about having a fine balance of diversification of portfolio by avoiding very expensive names while probably building a portfolio with those names which are reasonably valued in the current set of market. This happened in 2017 and it's again happening now if we look at it, wherein a certain segment of markets become too expensive while certain set of markets become cheap. So fund management on the active side is simply trying to build the portfolio and keep maneuvering the portfolio in favor of those sectors, those market capitalizations where there is value, where there is relative to price, there is margin of safety. And of course, the risks to that extent come down if you don't have very expensive names. And we've seen that in the past, right? That the greatest companies at very high valuations, if you buy, you don't end up necessarily making money in them. So it's a fine balance between price, value, and the growth that you have to set and create a portfolio as an active fund manager. Thank you.
Right. Mohit, given the potential higher costs associated with active management, how do you justify these expenses and what value does it bring to investors in the long run?
Look, Meghna, I think it's a known fact that there is a cost arbitrage between active and passive strategies. Active because it involves a fund manager's expertise, his time, his experience will always be a little more costly than the passive style of investing. And the difference in Indian markets is currently, let's say, around 1% odd between active strategies and passive strategies amongst the same market capitalization
Right.
bands. Right now, to think of it, 1% over a very long period of time might sound like a large amount of money if it compounds at a certain rate. But to think of it in another way, it's also an expertise of an experienced veteran fund manager, a professional who has qualifications, degrees, a team of research analysts, and as Chintan bhai rightly mentioned, who's tracking the ins and outs of market cycles, who's trying in and delivering that extra value to your portfolio on an incremental basis. And history also testifies, Meghna, if you look at the track record of different schemes, basically over a long period of time, which is 10 years, 15 years, 20-year kind of cycles, then amongst the small caps and mid caps, there is a definitive alpha which Indian fund managers have generated over the benchmark indices, right? So I think for that expertise, for that knowledge, you have to pay something extra because it finally adds on to your own portfolio, and the fund managers out there are delivering that extra return to a client's thing. So my sense is as long as you continue to get value, the cost is justified.
Right. Chintan, what key factors should investors consider when selecting actively managed funds, and how can they identify fund managers with a consistent track record?
So when it comes to fund management, consistent track record would mean you actually look at a 10-year, 15-year horizon and see how the fund manager has performed across a full market cycle. But apart from that, the way to select an active fund would be to see that in your overall portfolio mix, how are you wanting to create an asset allocation plan for yourself? Typically, the way we look at it is that you create a base foundation which is strong through the multi-asset funds and the balance advantage fund category. Then you basically build in the flexi cap funds or the blue chip funds because that gives you some stability as well to basically participate in the wider spectrum of the market in the mid and small cap segment or the sector thematic segment. You can have a certain set of funds which you can select. Now that is the difficult part because mid, small cap sectors, themes are not something which remain constant. There is volatility around that. And how do you create a portfolio out of them and which funds you select? So the consistency part is difficult in fund management. It's not consistency which you should look for. You should look for a longer term, how the fund has performed through the entire market cycle. When I say consistency, yes, if you look at 15 years, it's a good number. If you look at 10 years, it's a good number. If you look at 2, 3 years and say, oh, this fund manager is outperforming in the 2, 3 year period, that will not suffice as far as your long-term future appreciation is concerned, because in 2, 3 years, someone can do well, but if the market turns, that can actually go against you. So from an active fund management perspective, first is select the category properly. Within the category, if you actually create a good mixture of a fund set of funds like balance advantage fund, multi-asset fund, blue chip, flexi, value, put some sector thematic mid and small cap, create a good bouquet of these funds. I think that should do well because selecting the fund basis past performance, selecting the fund basis the fund manager may not be that easy for all. If someone is a sophisticated investor, I would say see the style of the fund manager. If the style of the fund manager is value and you can relate to value, have the patience, go for the value fund manager. If the style of the fund manager is growth oriented and the portfolio, while its PE looks expensive, it is still a good portfolio for you to have for the long term, and you can basically relate to it. So in a nutshell, it's not easy to select a portfolio, but I would say select 7 to 8 schemes within all of these categories which are available, and that should be a good mix for your long-term wealth creation. Thank you.
Right, right. That was well explained. Mohit, in a rapidly changing market, how does active investing adapt to capitalize on emerging opportunities? And what role does ongoing research play in making informed decisions?
Oh, massive role. Research and the fund management team, plus the style which Chintan Bhai was mentioning, plays in terms of how one can quickly adapt to the rapidly changing scenarios. Now, look, one big drawback with passive indices is that the readjustment or the rebalancing of the index happens on a fixed frequency. It might happen on a 6 monthly or a yearly frequency, right? But there are trends in a rapidly changing environment which move very fast, right? So a trend of a IT sector or a pharma sector might last for 2-3 months in the interim and then suddenly fizzle out, or a trend of a PSU perhaps might just peak up around budget, and maybe railways might just peak up around budget and then again suddenly taper down. So it is very difficult for a passive strategy to capture these trends which play out in the interim time till such
Right,
time that the index readjusts, because index in a passive is a market cap uh, 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 play. Basically, as the market cap of the companies increase or decrease, they move in and out of indices or various forms of indices, right? But these trends are in market cap agnostic. So here comes the expertise and the role of a research team or the fund management team who can identify these micro trends in the economy and capture them at a right opportune time, and then make sure that the investments are done and also the exits are done timely before this entire cycle plays out. So here I think the active strategies play a massive role, and if this works out very well, if those styles play out really well, then active can continue to deliver a huge amount of alpha over a long period of time.
right, right. Now for passive investing, Chintan, in what ways does passive investing provide diversification benefits to a portfolio, and how does it contribute to long-term wealth accumulation?
So, Mingda, if you look at it clearly, the knowledge about passive funds, the understanding, the awareness about passive funds has increased meaningfully in the last 6 to 7 years, especially after the pension funds were allowed to invest in passive funds in India. That category has grown meaningfully. Also, what has happened is in the last 4 to 5 years, a lot of AMCs have brought out differentiated products within the passive side on sector thematic, on smart beta, which has allowed investors to have a wider bouquet of investments within the passive funds. Passive funds, essentially, as the investors would already know, are funds which are basically replicating an underlying benchmark index. And as part of replication of the underlying benchmark index, an investor knows exactly where where his or her money is going. And apart from large, mid, and small cap, you have sectoral like banking, IT, pharma, uh, FMCG or consumption, infrastructure. Also, you have smart beta strategies like low vol, alpha low vol, momentum. So a lot more is available today. And in that context, clearly a portfolio, as I was mentioning, the active funds, which an investor should have 7 to 8 categories, well mixed depending on how much percentage an investor wants in each. There is a growing trend of having 75% in active, 25% in passive. Within passive, large cap passive is quite popular
Right.
because people are able to get the exposure to the, let's say, the blue chips of India in which are part of the index in a very seamless manner in the passive funds. But we are seeing increasing trend of investors also investing in various smart beta strategies like low vol, momentum. That is also gaining ground. And for those investors who themselves are quite savvy, they're basically approaching even the sector thematic. So say if someone wants to play the private bank theme right now because it's essentially gotten beaten down, the stocks, some of the stocks which are heavyweights have corrected, they can invest in the private banking ETF and take advantage of the current entry point and know exactly what they are going to get in terms of the underlying portfolio, which is focusing only on private banks. Similarly, if someone is betting on long-term growth in financialization of India, you have the financial services X-Bank index also, which can be possibly invested through the passive fund. So there are so many options available today, and hence we are seeing a good mix of active and passive as part of the overall portfolio mix for investors. Thank you.
Mohit, so he has already explained, but if you could elaborate, what are the key considerations when choosing a passive investment strategy, and how can investors ensure effective tracking of market indices?
Look, so selecting a passive fund is relatively easier to my mind than selecting an active fund. In active fund, you have to look at multiple variables, permutation combinations, fund managers, their expertise, their track record. In passive, you actually move out all those factors which are associated with the fund manager and his style. The key considerations, the biggest consideration becomes expense ratio. The lower the expense ratio, the better the fund becomes, and lower the tracking error also. So I think expense ratio and tracking error are two big considerations which one should keep in mind while selecting a passive fund. The second biggest factor to my mind is the overall assets or the AUM of the fund, right? You can't have a passive fund with very low AUM because then liquidity becomes a constraint and a challenge. One has to carefully consider if one is buying ETFs, then what is the liquidity on the exchange? The bid-ask spread should not be fairly huge, right? So in many passive strategies, we actually prefer FOF format because then it becomes easier to sell them off, going with the liquidity concern. So liquidity, the volumes on the index, the tracking error, and the expense ratio. I think those are key considerations, and the overall AUM of the schemes. These are the few big considerations which one has to keep in mind. One good part which I want to add here, which Chintan Bhai also alluded to in some manner, is that one buys passive. You can actually be very, very clear in mind that what you want to buy. You will only buy that. When you buy an active strategy, you are actually dependent and subjugated to a fund manager's whims and wishes at times, right? A fund manager might mix value with momentum, or might mix growth with a low wall or something like that. But when you buy a passive strategy, you are very, very clear that I want to buy only top 50 Nifty 50, and there has to be no mix of mid or small in it. Or I want to buy only value, and there has to be no mix of momentum in it, right? So you can be very clear, and that also helps you focus your investment, sharpen your overall philosophy, and have the right mix in your portfolio.
Right.
Thank you.
Chintan, can you elaborate on the role of exchange traded funds and index funds in passive investing, and how investors can strategically use them in their portfolios?
So I think strategically and structurally, both investors can use index funds and ETFs. Index funds are like mutual funds. They follow the benchmark and you get the day-end NAV. ETFs are traded real time on the stock exchange and you can buy and sell them like any other share, even in single units. So those are the differences between an index fund and an ETF. But essentially, both index funds and ETFs are tracking an underlying benchmark index and they are part of the group of passive offerings that mutual funds have. Now, how to create a portfolio or what portion of your portfolio should be part of passives? I would believe, like I said, as you understand more and more about passives, and passives is more a self-select mode wherein, based on your understanding of what you need in your portfolio, you actually create a portfolio of passive funds within yourself, unless, of course, you have an advisor who is basically building a portfolio which includes passive funds for you. I think, again, within passives, you should have clearly a certain portion to the traditional benchmark indices. I think most people would probably do well to have the entire 500 stock universe. Now imagine you have all the 500 stocks. So you'll probably get early entry into some of the large caps of tomorrow, which are today probably small caps, right? So the 500 index, which is there, be it NSE 500 or BSE 500 index, which is there, that can be looked at either in the ETF form or the index form, whatever is available, because that is essentially the entire Indian market, so to say. I mean, 500 stocks, if you go to buy, it will be impossible or most difficult for you to buy and manage. But in an ETF, if you get 500 stocks, so I think that should be a part of your portfolio. Beyond that, within sectors and smart beta, I would say many people are building their portfolios through having, apart from the market cap weighted, say 500 stocks, you have momentum as a core strategy. Some people who want to be conservative have low wall as a core strategy. So based on your risk appetite, you can decide if you want to be a little bit more aggressive, you invest a little in the momentum passive strategies. If you want to be a bit conservative, you invest in the low wall strategies within the passive side. And as far as sectors and themes are concerned, I think based on whichever sector or theme you like, you can allocate a certain percentage. So if you had 25% to allocate, I'd say 15% you can allocate in the 500 stock universe or the large cap and universe funds which are available. And the balance 10% you can spread between momentum, low vol, alpha low vol, as the case may be, and some of the sectors which you believe are likely to do well. So choice is yours. The good part about ETFs is that it allows you to buy even a single unit. So you can actually, even if you have a smaller corpus, keep building through the single unit, 2 units, 3 units, and eventually create a good corpus of ETFs with you, which will eventually benefit in the long run. Again, they being equity ETFs or equity in nature generally, I would advise investors to have a 5-year horizon when you're investing, unless, of course, you are very adept at shifting and maneuvering through a day-to-day mechanism or a weekly mechanism or a monthly mechanism, which involves a lot of expertise. And of course, you may not have the necessary expertise all the time. So keep a 5-year horizon, invest in a diversified manner within passives as well. A lot of choices are there, but I would say that stick to one of the funds between the 50, 30 or the 500 index, stick to one of the funds between low vol and momentum, and stick to one of the sector or thematic funds which you feel is best in today's current environment. Thank you.
Right. Mohit, as passive investing gains popularity, what potential pitfalls should investors be aware of, and how can they navigate these challenges for a successful investment journey?
Look, so I think over dependence on any one strategy could be fatal. And time and again, it has been proved people were too gung-ho about passive. And for last couple of years, if you see, active strategies in large caps have actually done better than passives. People were actually saying active strategies are doing much better in small and mid cap. Whereas if you see on an average for last 2 years, the passive strategies in mid and small have beaten the active strategies hands down, right? So times can change, styles can change. As Chintan bhai was saying, it's always good to have a proper mix and balance of both the strategies in any kind of portfolio. You should have a portfolio which comprises a good mix of active and passive. Never overly rely on any of the strategies, right? As of now, I think Indian markets give you a good opportunity to generate a lot of alpha. So be there in active strategies as well. And again, the larger point is choose your style of investing. Go with the value, go with the momentum style, depending on what would you prefer. So passive, active, and a good mix of factor based investing, which is the smart beta investing, also should be included in your portfolio, because finally, to figure out the right fund manager over consistently long periods of time can be a painful task. And unless you have a capable advisor who helps you doing that process in a systematic manner, it can become very tough. So for investors, it is easier to pick up a passive strategy and a style of investing through factor based methodology, rather than trying to figure out different alpha generating fund managers in different times and with different styles, right? So my sense is, if you create a proper mix, it should be a good one. And one thing which investors should considerably avoid is trying to churn a lot of in and out of both the strategies, going by past 1 year or 2 years of track record. I've seen a lot of investors moving into passive, redeeming from active just because last 1 year was great for passive, and vice versa. I think investors should have to avoid that temptation to move in and out of both the strategies. Both are very, very different philosophies altogether, and one has to test it over a very long period of time, perhaps 5 to 10 years, to exactly come on to a conclusion that yes, what will work best going forward. So yeah, that's my two bit on it.
Right. So with this, we have come to the end of today's episode. Thank you, Mr. Chintan. Thanks, Mr. Mohit, for joining us today. Viewers, we hope you have enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You can also share your suggestions and questions at editor@outlookmoney.com. We'll be back with our next edition soon. Till then, stay safe, stay invested, and keep following Outlook Money, your favorite personal finance magazine.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.